You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing and build real wealth.
Hello, I'm Deidre Woollard, an editor at Millionacres, and thank you so much for tuning in to the Millionacres Podcast. One of the aspects of real estate I'm particularly interested in is real estate crowdfunding. And I just feel like this is one of the most important innovations in real estate investing that we've ever seen. I think of it in terms of the creation of REITs in the 1960s as just being this massive change, allowing really a lot of investors to have access to things they wouldn't have had access to before. Here with me today is Mitch Rosen, Senior Director of Real Estate at Yieldstreet. We reviewed Yieldstreet on millionacres.com before, and one of the things that I'm really intrigued about with Yieldstreet is they don't just do real estate. They offer crowdfunding for a variety of kind of really fascinating assets, from art to loans. So, Mitch, welcome. Thank you for joining me.
Teacher, thanks for having me. I appreciate being here. Thank you.
Well, let's talk a little bit about the kinds of opportunities that Yieldstreet offers, because it is a lot more than real estate, even though real estate is your particular focus.
That's correct. So that's right. So Yieldstreet is really one of the only platforms out there that we know of that really provide a broad swath of asset classes available vis-a-vis crowdfunding. So when you think about Yieldstreet versus other competitors of ours, some of them are very specific to real estate or other asset classes like secondary shares or non-traded REITs. However, we provide our investors access to products like you mentioned, art finance, art loans, litigation finance, private business credit, single family rental product, commercial real estate, as well as marine finance. So we are unique in that we do provide a broad swath of products and asset types that others really don't traffic in.
So is the consideration then on a sector by sector basis or a deal by deal basis in terms of what Yieldstreet looks at? Are you kind of open to anything, or are there only these specific sectors that you want to focus in?
So within the sectors I highlighted, we have very specific skill sets. So for example, I've been in real estate for about 20 years. We have a team of folks who run our private business credit platform or vertical, have been in the business for over 20 years themselves. So the view here is that we really kind of try to incubate an asset class to see if it fits within the parameters of our investor base on a duration basis, on a yield basis, on the ability to source product. And when in fact we have that comfort, we'll go out and hire an expert within that field to help facilitate and grow that business. And so that's inherently how the business historically has grown from different verticals. When it started originally in 2015, the original asset class was actually litigation finance. And then over time, we've added different expertise and business lines to the platform to help facilitate additional product.
Interesting. Okay. So then you came in as an expert in real estate. Now, obviously, real estate is going through quite a lot of change lately. So, what are you seeing as opportunities?
You're right. Real estate is going through a fairly interesting period of time on the back of a lot of different factors. I'd say one, obviously, COVID being a very hot topic, if you will, no pun intended, in the sense of just its impact on virtually every piece of commercial real estate, from retail, hotel, back to work, hybrid office. I'd say the two biggest beneficiaries have clearly been industrial being one, logistics, e-commerce, last mile. And then the second one I would say is kind of like an ancillary class, like self-storage has been a big boon. But, the other main asset classes, retail in particular, I mentioned hospitality, office, multifamily has also been on a tear, right? The low rates for as long as they've been have made affordability for single family homes quite difficult for a lot of folks, particularly if they've lost their jobs, that it changes in the income position. And so multifamily has been continued to be a very strong asset class with strong growth in rents, strong occupancy, and just a continued chase for yield and stability, which multifamily historically has provided. And so we don't really see that abating anytime soon, particularly with rates being as low as they have and the lack of available housing, particularly affordable housing for home buyers. And I would just add one last point. Single family rental product, which really is an asset class that's not more than 10 to 12 years old, having started post the Great Recession of '08, has really established itself as a legitimate, large institutionally backed asset class. And I'd say every month for the last few months, you've had a large institutional investor come into the space and really plant a flag to grow that business. And even partnering with huge home builders like guys like Lennar, right, who'd recently announced a partnership with another private equity firm to grow the SFR business. So that I would almost categorize within the multifamily bucket, but a kind of a subset of that bucket.
Yeah, that's true. I've been fascinated by the growth in single family build to rent, and it's interesting to me, especially because in the Great Financial Crisis, obviously we saw the rise of things like Invitation Homes and companies like that, snapping up those foreclosed homes and building rental properties that way. This time we've got this whole other thing going on. You mentioned Lennar. I know I believe they're spinning off that into a whole separate business. There's really a lot happening in that space. Is that something that Yieldstreet is looking at in terms of multifamily? I know at Million Acres and at Mogul, that's something we've looked at is different communities that are being built strictly for built to rent.
Yeah, the answer is that's correct. There is this belief, and I think it's a legitimate one, that the demand for rental product, particularly with people migrating out of urban cores and look, this is really a COVID specific acceleration of that trend, right? I couldn't sit here today and argue that had COVID not happened, that you would have seen the migration to single family rentals outside urban markets as quickly as it's been adopted. The question becomes, do those folks who have moved out of these cities into homes with more space, with a yard, better schools, maybe, do they stay there? Do they migrate back to what they have experienced historically, which is, tighter, cramped quarters, but all the amenities that a city environment provides? And so I think it's very too soon to say which direction that goes. But the clear demand drivers right now are outside of core urban markets, suburban, exurban, where you are having home builders who may have built to sell homes now saying, you know what, I can create a stable cash flow stream, build maybe at a slightly lower cost with less optimal finishes, maybe not marble, maybe Formica countertops as an example, and make a really attractive return that provides me with consistent cash flows that can smoothen my revenue streams. So we're looking at a transaction where, in fact, we would be providing capital for an SFR community outside Chicago potentially. And the builder of those homes would be a national home builder who actually is already building homes in that community for sale. So they wouldn't be an owner in the community itself, but they would have the skill set and the team on site to facilitate the construction of those homes. So I do think that this is not going away. I think it's a trend that will continue to build institutional capital behind, and that people will choose to rent maybe in different ways than they've done historically.
Interesting. I'm wondering if one of the evolutions of this trend that we obviously seem to be in the midst of will then translate to either a rent to own or a home buying scenario, because right now it's, the prices are at historic highs. There's no inventory for existing homes. Home builders are trying to keep up. There's just a lot of pressure right now that's keeping people who maybe would buy out of the market. And I'm wondering if eventually some of these single family rentals become available for purchase.
The data is there that suggests that pre '08, there had been a huge speculation of home building price appreciation, demand, and they were going
Mm.
farther and farther out to find cheaper land to still make them somewhat affordable. And then you had this whole massive reset of pricing from, I'd say, 2009 through 2000, probably 15.
Right.
But when you keep rates as low as they have for so long, you inherently inflate asset value, right? If you can borrow at 2, 3% to buy a home, versus maybe borrowing at 5, 6, or 7% like you did in 2007, your ability to buy a larger or more expensive home becomes palatable. And so you did not have the same risk tolerance from the home builders. So you didn't see the inventory, go up like you would have expected it to for a long period of time. And now you're playing catch up with this huge influx of demand that can't be met by the existing supply. So I think the answer is that they're going to try to play catch up, but I think there's a long lead time for that. And so I don't think there's an easy solution. There have been a tremendous amount of multifamily units constructed in the last 5, 10 years in markets in the smile states, right? Arizona, New Mexico, Southern California, through Texas and Florida and up the coast, the eastern coast. Um, but the single family home specific product, people are staying renters for longer, and so that really is a tailwind for rental communities, and probably creates another tailwind for the home builders But the supply clearly is not meeting demand right now, and it's probably going to take that for some time.
Absolutely. And the other thing that I'm seeing too that makes me a little bit worried from the great financial crisis is that move to the exurbs. So, really getting further and further out from, from main cities. So that was part of what's happening, partly from COVID and people being able to remote work, partly from just people looking for cheaper homes. You've been looking at real estate a long time. I've been looking at real estate a long time. Everything cycles. Do you think eventually we're going to see more movement away from those suburbs again?
You know, there's so many pundits who have different opinions on this, and I don't purport to be an expert by any means. I do think that things tend to revert back to the mean over time, and that there's a shock to the system that causes people to act in ways that maybe they think maybe too short term and not on the longer term. So my inherent response would be that if you're 50 miles outside a city, that's a that in my mind, that's an exurb, right? You're a good hour drive at minimum.
Right.
And there may not be public transportation, whether it be trains or busing to urban core markets. I think the more relevant question is what do we think stays as permanent in regards to the work environment going forward? And every day there's a new article out. I saw an article yesterday about Jeffries, for example, an investment bank in New York that is moving to in a hoteling model. So there's hot desks. You're required to come in 1 to 3 days per week per your job, but you don't have an office anymore or a dedicated desk. Citigroup came out and announced yesterday there's a new CEO, a woman CEO there that announced that they are going to be requiring no more than 3 days of work in the office. And then there's other banks like I believe JP or others really want a back to 5 day a week in the office environment. So there will be a continued migration and discovery process as to what tact companies take, how it looks. I think it'd be hard to argue that hybrid is not going to be here for some long period of time, called 2 to 5 years, just based on the experience that companies have had the last 12 months. So I think that will be a better informed predictor of if the exurbs are reasonable to be living in full time or whether or not that fad goes away. If you could work outside and from home 3 days a week, I think commuting 2 days a week for an hour and a half each way is very palatable. If you told that same person you're commuting 4 or 5 days a week, I think that becomes a very difficult daily existence if you're on a train or commuting for 3 to 3.5 hours a day. I think it just becomes difficult. So my take is that I think it'll be employer and employee specific. But I would imagine that if you can work more and more remote, those exurbs become far more valuable. I'd also add that suburban office outside the cores also creates additional value, right? So there's been discussions at other companies where I have friends who work where they may create like satellite offices, one in Connecticut, one in Long Island, maybe one in Jersey. So you're not all coming to the central core. You're maybe commuting 20 minutes. And there's a smaller team there 1 or 2 a week. So I think they're all thinking through all of these questions and what works best for their employee base.
Yeah, I think that's absolutely true. That's one thing I'm seeing is that what they call that 3-2-2 work week where you're in the office 3 days. I think part of that is just that we all realized how awful our commutes were during this time period when we didn't have them and how much time we got back. And I think that's really important, that idea of having that time available for work and for family and for everything else.
Yes. I think there's a trade-off that comes with that, right? So you lose the camaraderie, you lose the culture a bit of the office space. So the question I always say, and I frame it this way: what is the incremental benefit of that additional day? I think it's very easy to argue that, um, or I would argue, excuse me, that maybe there's not that incremental value going from 4 days to 5 days, but certainly there's an incremental value from going from 2 to 3, maybe even 3 to 4. And every company will find out what their preferred path is. But I think, as a general statement, the exurb to your original question, the exurbs do have a reason for being, and very well could have a tailwind for some time as people kind of maybe work from home 3 days a week and go in twice a week.
Absolutely. So I want to talk a little bit about your background in CMBS loans because I think right now I'm seeing a lot of distressed asset funds come up kind of looking for, certainly CMBS loans for hospitality and for retail seem to be at a higher risk of default right now. What are you thinking about that, and what is happening on the CMBS loan front right now?
So, for folks who may not be aware of what CMBS is, CMBS stands for Commercial Mortgage-Backed Securities. And to explain that in very simple in a simple way is a bank, an originator originates 100 loans at $1 each. They package those loans into a pool and they syndicate and sell off the liabilities against those assets. And so insurance companies, money managers, hedge funds, high net worth individuals buy those liabilities, those bonds that pays them a fixed coupon that is coterminous with the underlying assets. So they primarily are 10-year fixed rate loans, and they often are comprised primarily, I'd say about 30% office, 20% retail, 15% hospitality, probably 20% multifamily, and then the balance is other, maybe special self storage, maybe healthcare, maybe some other asset, cash flowing assets. Inherently, what happens with CMBS is that um, you're not directly facing a direct lender. So if you go to an insurance company or a bank today and get a home mortgage, you have a contact there. They hold the loan. They balance you the loan. They hold the loan. You have an agent that you talk to, or a salesperson, or someone who put you in that loan that you can call and say, "Hey, you know what? I need help making this payment this month, or I have a problem that's arisen. I need some help or facilitating a solution." With CMPS, they're governed by very different rules. And so there's a whole series of steps that has to happen if a problem does arise to getting that problem resolved. And so what may take you 1 or 2 months, if a lender of mine calls me and says, "Hey, listen, a tenant vacated. I would like prefer to use that reserve to pay the interest this month," I could say yes or no. With a CMBS loan, it's a 3 to 6 month process to get an answer on things. And so inherently, loans that probably could be resolved in short order take longer to resolve. And the average default period for a loan from a default to a foreclosure or REO could take as much as 2 years or more. So I think the point I'm highlighting is that it's a great way for a borrower to finance very attractively priced loans and get debt, but it comes with some complexities and some restrictions that I think people don't appreciate. And so right now, if you think about hotels and retail, particularly, those are two asset classes that are tremendously suffering during COVID. Particularly malls, right? Is a big buzzword, malls and the destruction of the value in malls. And malls historically has been a very attractive asset class for CMBS. It's long-term leases. They have large, strong anchors historically that anchor the property. They have large institutional owners like Washington Prime, like P REIT, like Simon, like Brookfield, like Macerich, like Taubman. Large multi-cap public companies. The fact is that those are all suffering in many different ways right now. And so as a result, those loans are going into default, or those loans are having problems meeting debt service. And so the investors in those pools are going to see losses be taken. And that's really, I think, where people are trying to figure out, okay, what pool do I like? What assets do I want to avoid? And which assets do I want to make a bet on? And I think that will take some time to shake out, but I think that's what investors are focusing on in CMBS.
Interesting. I think the other factor too that I've watched in commercial real estate over the past year is that everything's really slowed down so hard during COVID. And now it seems like there may be some confusion about pricing. There hasn't seemed to be any really deep discounts in pricing, even though there are some vacancies and some distress in the market. Is that something that you're taking a look at as well?
It's a great point because it's actually very accurate. There was a whole host of capital raised, I would say, from June of 2020 through probably Jan of 21, maybe even still to this day, where there had been some expectation or some hope of wholesale liquidations of loan portfolios or properties that were in distress. And the reality is that very little, of any meaningful volume, came out of that. And the reason is twofold. One is that if you're a lender and you have a problem with a loan, effectively your means of resolving that loan vis-a-vis courts or foreclosure were really close to you. So you really had only one option, and that was work with your borrower as best you can and find a solution. I know at Yieldstreet we did that with almost all of our borrowers. As long as they were commercial and reasonable, we tried to work with them. From the standpoint of the banks, the Fed and the OCC and all the regulatory authorities really provided the banks with a tremendous runway to facilitate workouts or kicking the can down the road, as they say, right? They don't want to take losses in the worst time to take a loan sale. And so you've had some positive momentum the last 3 or 4 months. I would advocate that if we continue on this trajectory of recovery, I would not be surprised if the whole deluge of defaults and distress opportunities maybe don't come to fruition the way people expected. And so I am of the belief that, particularly for hotels, I'm quite bullish on hotels. I think people will dramatically seek to travel and re-engage in their lives, whether it be business and or pleasure, leisure travel, I should say. I do think that industrial continue to outperform, and I think neighborhood retail will continue to perform very strongly. Thinking about a neighborhood shopping center, grocery anchored, nail salon, hair salon, travel agency, a restaurant or two. Maybe there's a Five Below or a Best Buy, whatever it may be. I think those aren't going anywhere. I think the acute pain is really about around retail and particularly apparel, right? Like, how many stores you need selling clothes in a mall? You don't need 50 of them, right? So I think I really differentiate between like services retail versus, material consumer retail. There's a difference. Office is probably the biggest wild card, I would say. That's really where it's the hardest to value. But you're right, there have not been a lot of prints or numbers to look at of what something's trading for to get a sense of where the market is. It's very opaque.
Yeah, and it sort of makes me think about what we've seen in the stock market, right? We've seen in the beginning during COVID, there was this interest in anything that was related to work from home. And the same thing kind of happened in real estate, industrial, data centers, things like that, self storage to some extent. Now we've got on the stock market side, we've got an interest in reopening stocks. And this is also translated over to hotels and retail. So in my opinion, that seems to be playing out in real estate too, and it may lift up hospitality. I just think the more I look at the amount of CMBS loans in the hospitality sector, it does seem like some of that is going to end up being distressed.
Well, we already have seen keys been given back or hotels shut in New York City, as an example, right? I mean, some very large hotels, in fact, right? So you can't repurpose every hotel as multifamily. It just doesn't work. Some will and some won't. Some may be office, but I mean, that process will take years to play out. But I agree with you that those hotel loans probably will not be able to come back quick enough to satisfy a repayment of that maturity date or cover debt service in any meaningful short time. If the borrower doesn't have the capital to support it, it's going to be hard to envision a scenario where a lender does not get paid and kind of just waits. So that would be my take on that particular segment. And again, you have to differentiate different kinds of hotels, like convention center hotels, like in Vegas, and other large hotels with large meeting spaces. That would probably be the last to recover, in my opinion, because there's inherently going to be a component of the population that maybe doesn't want to travel to a large gathering with thousands of people in a closed room, despite vaccinations and other protections. Whereas if I was going to visit some clients in LA, I may be happy to stay in a hotel, have my own room, not be in a confined room with thousands of people, maybe meet one-on-one meetings, coffee, drinks, whatever it may be. So that's how I think about it. I wonder how pervasive that view is. But I certainly think about going to a convention these days and probably saying, you know what, I'll probably wait a little bit.
I think that's really smart. I think a lot of us are having that feeling, that little bit of anxiety about being with a large group of people right now. All right, well, let's take a quick break right here.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
During our break today, we are excited to have Millionacres lead investment analyst Matt Argersinger here to speak briefly about one of our newest services, Real Estate Winners. Thank you for joining us, Matt.
Thanks for having me.
So what is Real Estate Winners and who is it for?
Well, I like to think of Real Estate Winners as our answer to Stock Advisor in the real estate market. It is a service that provides recommendations on publicly traded real estate investment trusts and real estate companies. So it's a pretty big universe out there. There's over 200 REITs to choose from, and probably dozens, if not hundreds, of real estate companies are in our universe. And we provide regular investment recommendations as well as commentary on the market, educational material. And it's really designed to get anyone who's interested in investing and learning about real estate started.
So is it geared toward new investors or is it more for seasoned pros?
I think Real Estate Winners can serve both. I think if you're a new investor, maybe you're just getting started with stocks and you want to learn more about how to add real estate to your portfolio, great place to start. If you're a seasoned investor and just thinking, okay, how can I diversify my portfolio, maybe reduce the volatility in my portfolio, maybe add some income to my portfolio, then I think Real Estate Winners is a great solution for that cohort as well.
Fantastic. What are the benefits of being a member of Real Estate Winners?
Number one benefit is day one when you join, you get our top 10 investment ideas at the moment. So really right from the beginning, you know what our 10 best ideas in the publicly traded real estate market are. And then going forward on a monthly basis, you'll get a new recommendation, sometimes more than one new recommendation, as well as regular content that we're coming out. We're covering our past recommendations, providing updates, and talking about the real estate market. So it's really the full package.
Perfect. So what do you need to get started?
Really all you need is a discount brokerage account. So if you're used to buying stocks, and you probably already have that. If you haven't bought stocks in the past, of course, just open a discount brokerage account. These days, you don't even have to pay commissions. It's fantastic. So it really couldn't be easier to get started investing with real estate winners.
Sounds fantastic. So how can people sign up?
Sure, they can head over to real.fool.com. That's real.fool.com.
Great. Thank you so much, Matt.
I'm back with Mitch Rosen of Yieldstreet. So Yieldstreet launched something called the Prism Fund, and I thought that was a pretty interesting concept. Can you explain a little bit about that? It's not strictly real estate, right?
That's correct. Right. So when one restriction that people have to acknowledge when they invest with Yieldstreet today is what kind of accreditation they have to meet. And there's a terminology called accredited investor, which maybe you are familiar with and your investors are, but it has certain thresholds of income and net worth that people have to meet to enable them to invest in certain of our offerings. We wanted to create a product that really meets the mission of the business, which is really providing access to all investors, regardless of where their income levels stand. And the way to do that today is vis-a-vis the Prism Fund, which has basically a availability to all investors, regardless of income, and a very low minimum entry point. And the goal of that fund was basically to provide two things. One is access or breadth of all of the asset classes we participate in, right? So an art loan may be in there, a real estate loan may be in there, private business credit, marine. So it has a cross diversified pool across all the asset classes. But secondly, a really easy entry point, $1,000, right? So um, regardless of your income level, to some degree, if people are investing, let's say $1,000 in their IRA or their 401k or stocks, we are saying that this shouldn't replace that per se, but could be a complement to that. And that's been really a big driver of our new user demand is people trying the Prism as an entry product for us, experiencing it, seeing how we update them, and then getting comfortable with it and hopefully migrating to individual offerings or other funds that we offer. That's the primary driver of what that fund is and what it does.
Interesting. And can you hold that fund in like an SDIRA or a retirement account?
I believe you can. I don't want to speak out of turn. I believe you can, but I will get you an answer for that question.
So I want to know a little bit about your personal journey, how you became interested in real estate, and what led you to Yieldstreet.
I've been in real estate for about 20 years, most of my career. When I graduated college in 2000, I'd gone to the investment banking world out of college for about a year. And I came out in the euphoria of the dot-com world, but also went through the dot-com crash, which as a first-year analyst, I learned is not a great spot to be in. I left JP Morgan where I was at the time, and I effectively looked at the landscape and said, what is something that's tangible that interests me and that still has an investing aspect to it? Excuse me. And real estate really kept those boxes off. I went to go work for, at the time, a public mortgage REIT called Capital Trust as a junior analyst out of a year out of college. And I really learned the business from my mentors there. How to underwrite real estate, how to value real estate, how to structure real estate, how to think about risks, how to mitigate those risks, what kind of borrowers you want to invest with and lend to versus the ones you may want to avoid for a whole host of reasons, not just because of their cash in their pocket, but the problems that may arise or the way, in fact, they treat their partners. And so great learning experience. I then went to another fund called Marathon Asset Management and then another fund called Brigade Capital, trading, investing, CMBS, as you mentioned, bridge lending. I met with Michael and Milland in the summer of 2018 after having left my prior employer. And they were really trying to provide a vision for how I could see the real estate business growing here and the demand and the opportunity set that really was available to retail, particularly with the Jobs Act of 2012 and all of the impacts that had on particularly crowdfunding and particularly even more so real estate. Real estate has a really unique niche within these rules that provided an ease of access that other asset classes do not. And so that's partly why there's probably more crowdfunding sites that dedicated to CRE than any other asset class. And there's inherently advantages in CRE in our tax code, right? Whether it be 1031 exchange or the ability to, if you're in the CRE business, a real estate business, you can take depreciation against your income, right? So there's a whole host of ways in which REIT status, right? You can distribute income tax free if you meet the REIT status rule. So for me, that opportunity set was quite attractive, and to grow a business and kind of lead that effort was really attractive to me at Yieldstreet. And that's why I joined, over now 2.5 years ago.
I love that. Okay, you mentioned the Tax Cuts and Jobs Act. So that leads me to have to ask you about opportunity zones, what you're thinking about those, how they've evolved, and if that's something that you look at when you're looking at real estate investments for Yieldstreet.
Yeah, I'm not a big fan of opportunity zone investments, personally. They have a very, very long time horizon to take the full benefit of those tax benefits. You have to also have capital gains to roll into the deal, so you're inherently selling something that may have made money to avoid some taxes. Um, my sense, and I'm speaking in very general terms here, is that um, people are maybe utilizing the structure as a tax avoidance and to mitigate their taxes up front with the hope that these projects pan out. And I would argue that some of the deals that I've seen in OZ zones are maybe driven as much by the tax benefit as they are by the underlying property or income generating potential of the asset. So I would think if you ask 10 people in CRE, I would say most of them would say that the OZ program has been a little bit underwhelming in terms of how much capital was raised and how much has been done. But that's again my personal opinion. I think it's great from a standpoint of really trying to get capital into those parts of the cities that really need it and to incentivize them. I hope it solves for part of the solutions they're trying to seek answers to. I don't think we'll know for 5 or 10 years where it shakes out.
That's a really, really good perspective. Thank you. And that makes me wonder a bit about your underwriting process in general, what you're looking for, and also how many of the deals that pass by your desk end up going on the platform.
Good question. So my nickname here is the Terminator.
I love it.
They say I kill 98% of the deals that come across our desk. When I think about my role here at Yieldstreet, particularly with the real estate platform, is my job is to ensure that our investors have their principal protected and get the coupon that they're signing up for. We never want to take a property back if we don't have to. We want to kind of make that loan or that investment, earn our return of our capital, and pay our investors back their money. So I answer that in that way to say that when we do these investments, I really put myself in our investors' shoes. And I think about, okay, I look at the market, I look at the borrower's capacity. Is this something they've done before? If so, when did they do it? How experienced are they? How does their balance sheet look? Any litigation, any fights with other partners, any criminal issues? Is their credit score good or bad? I mean, I can't tell you how many people show $100 million net worth on their statement, but have a 540 credit score. To me, that right, that to me that doesn't quite compute. So those are things that we all look at. In terms of underwriting, I mean, I was trained in a very detailed underwriting shop coming into the business, and so I mean, we review everything. We do a full deep dive. We look at appraisal phase one, a private condition report. We order a survey. We hire our own legal counsel to represent Yieldstreet's interests. We do full borrower background checks, org structure, KYC. We underwrite the market, underwrite the property. We underwrite the sales comps, leasing comps. I mean, we do a full deep dive to ensure that we're kind of checking the boxes and ensuring that we are lending on the value that we think we are lending against. And there are certain, ways that you can structure around certain risks. For example, if you're doing a condo deal, you want to incentivize that borrower to sell units to pay you down. And so you may create an incentive to sell down sooner rather than later, so your basis is reduced quicker, right? So there are structural nuances that one can utilize to try to align the interest with the borrower that may not be so optically clear, but get you to the same spot as where you want to be.
Excellent. Thank you. So I have to ask how Yieldstreet makes its money, because one of the things that when we talk about crowdfunding, I always want people to be aware of what the fees are. Different companies operate in different ways. What does that look like for Yieldstreet?
Great. So we're an SEC registered investment advisor. So we are paid as a manager of these various offerings, a management fee. It could be as low as 1%, as much as 2%, depending on the offering specifically that we're providing. In addition to that, there are ancillary fees on a deal level that we do earn that are all disclosed in our offering pages and our documents. It could be an origination fee, it could be an exit fee, maybe an extension fee. That is also part of our general compensation for managing the investments, sourcing the investments, working with the borrower, working with our partners, and ensuring a repayment of that loan.
Excellent. Thank you. So, in a recent episode of the Yieldstreet podcast, which is The Yield, to give it a shout out, you mentioned golf as an investment. And I think that's really fascinating because before the pandemic, I heard all of this talk about golf communities in Florida, et cetera. They're over nobody wants to golf. Then all of a sudden, golf turns out to be a really great social distancing activity. Now I feel like there's a little bit more interest in golf. How do you think investors should be thinking about golf communities in the short term and also in the long term?
So we had a partner on that call named Jerry Sager of First National. Jerry Sager and First National is probably the largest golf lender and investor in the US the last 15 or so years. And so I historically have not thought of as golf as a real estate asset class. But in many ways it is, right? There's a land component, there's a alternative use component, there's an income component from the hospitality aspect of playing around a golf. And so he has a lot of data around which golf courses succeed and why, and which ones fail and why. It's often demographically based, it's often concentration based. And what we learned is that, you're right, golf is a very ideal socially distanced activity. It's outdoors. It's enjoyable for most people. It's something they can pick up and play with their friends and be safe doing so. And so, um, Jerry has made a tremendous amount of money for him and his investors by investing in loans and or equity in golf courses, private and public. And so, I really want to highlight that for our investors that in fact, it is an asset class that you can consider commercial real estate. While it's kind of an esoteric asset class, it does exist, um, and how it continues to grow in many ways. I agree with your point, though, that for many years, I'd say starting 5 or 6 years ago, there's probably by far an oversupply of golf courses for the number of golfers we had in this country. And many of those have closed. Actually, a lot of number of golf courses in the U.S. have closed year over year the last 5 years. I can't speak to whether that continues or not, but if you pick the right courses to back, there is good money to be made as a lender and or an owner. And I think Jerry's kind of proven that.
Yeah, I think it's really fascinating. I think that's one of the things that has been most interesting about this pandemic is the difference between figuring out what seems to be a COVID trend and what seems to be a longer term, long tail trend. It's been one of them things has been like senior housing, obviously bad year for that, but long term demographics seem to indicate that we're going to need more of it.
Yeah, I completely concur with you. I'm not as experienced, frankly, in lending on on the skilled nursing, memory care, or independent living side. But the fact is that it's undoubtedly the fact that the government has a vested interest in seeing those businesses succeed and be around. And that's why you've seen through the various stimulus bills huge swaths of capital being deployed into those operators to ensure that they're around and they're viable. Because there's nowhere else to put these folks. That's the sad part, right? There's nowhere else for them to go. And so I think certainly 2020 was a very, very tough year for them, and getting people comfortable to be in those facilities is hard. And there will be a adjustment period post COVID as people get more comfortable and what steps are taken to ensure what happened in 2020 does not happen again to these residents. And that's going to be a very big focal point for the operators. But undeniably, the number of people turning 70 every day continues to grow exponentially, probably for the next 10 to 15 years. And so these asset classes have a need to exist, a reason to exist, and there's not enough of it.
Yeah, that's very true. One thing about Yieldstreet I've noticed is your hold periods are a little shorter than some of the other crowdfunding platforms. Is that a deliberate choice? What does that give you in terms of optionality?
It's a good question. So when you think about the yields that we're targeting, ideally 8% net to our investors and higher right now, um, it's hard to achieve that kind of yield on a longer duration loan. We're really targeting bridge loans, right? These are loans that have some component of change occurring. It could be a hotel converting to multifamily. It could be multifamily value add. It could be a land play with a construction loan takeout. Few people want to borrow at the rates that we charge for long periods of time because the inherent cash flow these properties generate on a longer period of time probably can't sustain it on a viable basis. And so we're really trying to effectuate a specific business plan with our loan, with our borrower, with the eventual goal of either cash flow going up and a permanent loan replacing our loan, or a takeout loan of some sort after some business plan has been completed. So it could be the retenanting of a retail center that had lost some tenants and they want to kind of backfill that space. It could be a multifamily property that's well below market on market rents. It needs some TLC, some capex to improve the units. They raise rents and they refi us out with Fannie or Freddie. Those are some examples of the kinds of loans we've done before and that we will continue to do going forward. I would love to be in a position here today to say I could do 5% loans at 5-year term. The demand is not really there yet across, I would say, alternatives and particularly retail. And the goal with Yieldstreet and with the CRE business here in particular is to get to that point so we could offer the breadth of duration and yield to all of our investors. That's the ultimate goal.
Interesting. So does that shorter time period also eliminate the need for something like a capital call or, a need for more infusion of cash into a project?
The answer is yes. I mean, we've never really called capital to date on any of our debt investments. We have funded some capital to protect the investors in limited circumstances to ensure that like for example, if there was leverage on the underlying loan, that we were protecting our investors so that they were not going to be losing their collateral position. We've done that in very, very limited examples, but it was successful. But in most cases, we are not calling capital investors because it's a loan. It should perform hopefully as it's expected to and underwritten, and it's repaying at the time we expect. On the equity side, it's a little bit different, right? If you're equity, you are inherently the first loss. So if the event that there is capital needed, there is this expectation that investors may have to come out of pocket to fund, let's say, a working capital reserve or a capital call for some CapEx or debt service. We've not gone through that process yet, but it is something that all equity investors in general are aware of when you invest as a first loss piece.
Exactly. How worried are you about interest rates going up in the short term or medium term?
I learned early on in my career that we can underwrite rents, we can underwrite vacancy. You can't really underwrite two things. I'd say environmental risk and rates as a CRE investor. So I really try to be agnostic to rates and ensure that I'm protected. Meaning, if I have a floating rate liability, maybe a loan on loan, I better be sure I have a floating rate underlying asset, so I'm not mismatched. Um, Higher rates in general are not great for CRE. CRE acts somewhat like a fixed income instrument. You have longer term, most cases, longer term fixed rate leases. However, your expenses can obviously modulate. Your debt service can modulate if you're a floating rate loan. And so your risk free rate, if it goes up, you're going to probably want to receive a higher rate of return as a buyer of equity. Even though in 2007, when LIBOR was over 5%, cap rates were still below LIBOR rate, right? Because you were betting on that future growth, that future rent growth. Now, in that case, it didn't come to fruition. I think people are much more conservative and thoughtful as to how they're going to invest their money. But I would argue it's hard to say that if rates don't move higher, investors would not expect to receive a higher rate of return. I think that's likely going to happen. It should either hold valuations flat or in some cases maybe potentially reduce them.
Thank you so much. So just to wrap up, how do you personally invest in real estate? Are you a real estate investor on your own? Are you investing in Yieldstreet deals? What is your real estate investment portfolio looks like right now?
I'm primarily invested in stocks and bonds. I'm also an investor in the Yieldstreet Prism Fund personally. I put money in there to get a broad swath of the products that we offer our investors. And the view is that when you're so ingrained in the individual deals that one is doing, providing a broader kind of investment product where I'm getting a breadth of all of the asset classes really provides some diversification. On my own, personally, outside of Yieldstreet, I don't really, buy spec houses. I'm not buying a roof stock share or anything like that. I'm basically focused on what I can control and not control. And that's basically how I think about it.
Awesome. Great. Well, Mitch, thank you so much for your time today. And a reminder to listeners, you can learn more at yieldstreet.com. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss that Millionacres or The Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.